one of the companies, gaming company that I was involved in, I think the entrepreneurs even said, because of using your capital at that time, we saved ourselves, each of the two co-founders, like $20 million each because they didn't take the dilution.
On this episode, this is going to be an interesting episode because usually I talk to startup founders and then we talk about, raising money, venture capital from a certain lens, from the lens of the startup founder. But in today's episode, we have Kai Tse, managing partner of Structural Capital, which actually provides growth capital for startups. And so this is an interesting episode because Kai founded, his company is actually a firm.
We're a startup too. We were a startup. We were a startup. Yeah.
Yeah, but a startup that serves startups from a capital side. So welcome to the show, Kai. Great to have you.
Pat. Yeah, it's good to connect and to kind of tell everyone about our story and about some of the backgrounds here and some of the uniqueness and and how we got where we are. I think happy to do that.
Yeah. Well, we actually met at my first job. So my first gig
was that your first job, really?
Coming out of school.
Oh wow, okay.
Was working for vcapital.com, and this was at the height of first wave of startup.com boom, and some of my we worked so many hours a day. At one point, it is funny because let me tell you the story. Like you probably saw it from a different lens, but they were working out of another company's office. So I at the time I wasn't at vCapital yet, but I was seeing the vCapital team working, and they would work they would come in the afternoon, but then they would leave at like 3:00 in the morning. And I said, at one point I'm like, well, why don't you just come in at 8 and then leave it earlier? Like, yeah, you don't know what you're talking about. And then at one point I got recruited into the firm, and it literally took maybe 2 days for me to fix to kind of, because what happened was it didn't matter if you came in at 8, you still left at 3. So it took like, I don't know, all of 2 days to kind of like figure out that no matter what time you came in,
you left at the same time.
You all left at the same time due to peer pressure. So and some people even, like, there were times when it was crunch mode where people slept underneath the tables, the desks. Like I just slept on the couch. I was kind of like a, hoity-toity. Like I needed a couch. I wasn't going to sleep on the floor underneath the desk or anything like that.
We can make this informal, but I'll tell you some really funny stories because I've been involved in some really exciting companies and some that we didn't end up doing for whatever reason. But I'll give you one example. The guys at Box. So when they first started, and these guys were like, I apologize, there's kids in the background playing VR. They're on spring break. These guys were literally sleeping under the desks, and there's a lot of poker playing in Silicon Valley, and so there were some groups that were playing poker, and they would host the games sometimes at the Box office. This was in Palo Alto at a house. This is when they're one of their first offices. And acquaintance / friend of mine, became kind of the sort of like the VP of Biz Dev, but she was the den mother because she was the only woman there, and she was a little bit older than these 22-year-old kids, 21-year-old guys. They were great guys, but they were young and fearless as hell and awesome at the end of the day. But you literally, they would sleep in the office, and she would get in the morning, and some of the stories would be like they're literally sleeping under the desks in like sleeping bags or whatever it is. And that was like the brutal reality of like really going guerrilla and just being hungry.
Yeah.
And interestingly enough, I was involved with Riot Games to make League of Legends, as everyone knows. And one of the funny things about gaming companies, when you get there and you visit the offices, it's like, this is before they launched product. You see the number of Coke cans literally stacked up on developers' desks, and that's how you could tell how hardcore they were. Like you'd have like rows of like 7-8 cans standing up, empty cans. Yeah. And that was like, you could tell these guys were really hardcore.
I was doing mom dues. Yeah.
Yeah, exactly. Really So I hear you and everything you say. I mean, I'm not a developer, I'm a finance guy, but I saw it. I'm like, okay, these guys are working hard.
Yeah, it
Versus the
was.
companies where there's no one there, and you're like, something's not right here.
Yeah, it was definitely not healthy. And our, like, I don't know if you remember Andy, who's a developer. He's,
Yeah,
we're
I
still
remember the
friends
name.
today, but we this was also at a time when like things like Amazon and eBay were new,
Yep.
and we couldn't leave the office. We were there the whole time, right? And by the time you get out at 3, everything was closed. So like, I remember Andy at some point, he was so stressed out that he would just like buy ridiculous shit, would just show up at the office. He would buy like a guitar signed by some famous guitarist on eBay that he like, bought on eBay, that won a bid, because we couldn't get out, and the all these new services were coming out, so we were excited about that too. But also, like, it was our way of coping, right? Like, you get out at night and you have limited options for food, you eat whatever. And so we were just, both of us were buying toys just to kind of, and not that we even had time to play with those tech toys, right? you
Yeah.
know
Yeah.
so
Well, you talk about eBay. It's so funny. I got out here at the tail end, the very edge and end of the boom of that internet boom, and one of the good friends I've made, who's still a very good friend. He worked at General Magic with Pierre, and he keeps telling the stories like Pierre, was selling the pet stuff at night, and one day he comes in the office and he's like, "Hey, I'm looking for like 3 guys to help me start this company. We're selling pest dispensers, and we're selling other things too." And everyone was like, "What are you, kind of crazy, right?" So of course that's eBay later, right? And many people are kicking themselves. I do think I seem to remember maybe one of the 2 guys actually went with him, but I don't know for sure. But you hear those stories, and it's just amazing. But I think what's interesting is the world's gotten a lot flatter, and Silicon Valley is still kind of the epicenter, but it's in many ways a lot more democratized in terms of the ability to kind of create successful companies in a lot of different places now, and because technology has become a lot more prevalent, and having the the patent on something, or having the center of universe around all the talent, it's not as, I think, is not as 100% locked in now here, also because of the cost of living, but also because raising capital is still the best here, but there's a lot of capital in a lot of other places that we're starting to see. So I think it bodes well for technology innovation across the US as an example.
yeah. There's still a lot of cachet, though, both from a reputation and like sort of like a gravity, right? Like, all the talent is here. Um, I,
Yeah.
when I have frequent trips to Thailand, and one, there's like a, corporate VCs, right? Like, there's corporate VCs. I met some VCs from Thailand, and one of the things that was funny or strange was like, yeah, this particular one only invests in Silicon Valley companies, right? Like, there's like, it's Thai corporate VC capital, but and they, everything else doesn't look as good as, like, the returns are not still not as good as the Silicon Valley tech companies. So there's still kind of like that cachet, and all that, the gravity and all the talent here, right? Everybody knows how to scale unicorn companies here, whereas somewhere else in other parts of the world, they just don't have that talent who can do that.
Yeah, no, that's right. There is a uniqueness in the talent and the capital pool, and then the co-opetition element of things, where you could basically have a company started, and then in 12, 18 months, you can have 100 million raised, and really start scaling the business quickly with some of the best of the world. But from what we do, interestingly enough, that's great. But we think that, in my business, and we can get into that in a second, we finance growth companies of all sorts, right? And primarily they're all venture backed, but we don't have as much of a stigma in terms of saying you have to be backed by one of the top 5 VCs as other people in our space do. And for us, it's really about finding good growth companies that have the ability to get profitable, the ability to scale the business, but giving them the option to do both, so that they're not constantly forced to raise equity as the only source of expansion capital. And that's really kind of how we think about the business. And that creates a much broader opportunity when you look, broadly around the ecosystem of how companies get started, how they grow, and how they kind of go throughout their life cycle.
Yeah.
And so we think it's quite exciting in terms of how we think about the business. And so it's not purely Silicon Valley centric, and we think there's a much broader opportunity set for providing various sorts of financing to help these businesses grow.
Yeah. So now that we have a VC kind of doing the interview, I think it'd be great for some of the founder audience members. Yeah, what makes for a great startup to invest in for you? What do you
Sorry.
look for?
What
Yeah,
do I look for?
yeah,
Interestingly enough, so just by way of background, when I got out here, I came out for a venture capital job, and then into the dot-com bust, ended up helping to launch a firm, which is now one of the bigger players in the space, as a first hired investment professional, and then launching this firm. But what I saw between my last firm and launching this firm was that there's a lot of unmet need in terms of opportunity set where companies, as an example, as one example, um, when companies are typically later in their life cycle, they may be Series D, E, or C, and they've gotten past a lot of what venture capitalists typically finance. In the early parts of their own funds, there's a need for capital for these companies to continue growing because fundamentally, many of them, they may last 10, 15, 20 years. And so what happens to a lot of the equity capital, post year 10, it kind of dries up. And so as a result, there's a lack of capital around that space. And so that's kind of one of the areas that we saw, in particular, I saw, given my background, that got me interested in kind of really kind of approaching this way. And the way to approach it is really fundamentally to underwrite the businesses. And a lot of VCs, they focus on teams and markets, and they're there to take the product risk. Our business is not there to take the product risk fundamentally, I believe. I've been through that in another firm where we did take product risk because we were basically focused on backing up the VCs, the top VCs, and with their equity investments with some debt. And sometimes it works. Most times it does work. Sometimes it doesn't work. And when you get into a downturn, as an example, and it doesn't work, that's not great for a lender, right? And so what I've learned throughout this multiple cycles is you take out some of the risk out of that and you focus on growth companies. Sometimes they're a little earlier with high growth. And what you're really then selling to them in the capital you're providing is that you're going to save a lot of dilution by using alternative sources of capital. You have a great partner because my team and I, we all have started companies. We've all been on the VC side or growth equity side. And so we know how companies are built. And we've actually helped a lot of our businesses with either raising capital, recruiting, business development, in some cases, even exit strategies. So in many ways, we actually operate sort of as a quasi sort of VC, but we look at it from a much less dilutive standpoint using debt capital and warrants as part of our compensation. And we write small equity checks. But most of what we do ends up being these later stage companies. Some are growing 50%, some are growing 100%, some are growing 20%. And in many cases, the ones that are sort of out of that traditional venture capital growth stage, where they're not growing as fast anymore, those are really interesting to us because many of them are actually closer to profitability because they have to start thinking about it that way, right? They have to start thinking about profitability as a measure of success versus I've got to grow,
through
and
growth. Yeah,
keep raising money and keep getting diluted till I hit an exit. And
yeah,
so that's great, but what if you didn't have to do that? What if you could grow at your own pace that makes sense, where it's still an exciting company, and you're not subject to really kind of constraints set by specific venture board members or what have you, or even corporate VC. And so we work well in conjunction in the ecosystem as a result in many different types of situations with our type of capital. And a lot of people in our space, traditional venture lenders, which is our space, they're more focused on who's the equity coming in, can I leverage that equity, versus focusing on the business.
yeah.
And is this a good growth business fundamentally that we can back? And so it's a very different perspective that we've brought to the table. And we think the market is really starting to appreciate that.
Who are some of the clients that you've backed that people might have heard of?
Yeah, some good ones. In structural, we've backed Noom, the fitness, excuse me, the weight loss app, which is much bigger than that. It's really kind of cognitive behavioral therapy. It's done incredibly well. Interestingly enough, and this is part of our model, we got involved after the company was 10 years old, back to the same point, and they had changed business models a couple times. And as I recall in the conversations, they had really just really started honing in and had really gotten the model, the economic model right, and the growth model right with the new business model. And at that juncture, for us, it was, you know what, we think they've taken out a lot of the equity risk, and this is a good situation for using growth capital in the form of debt, which is just much less dilutive. And that round, or excuse me, that year, they did much better than planned. And then the following, basically 6 months later, Sequoia came in and led a very significant up round, a very significant up round. And then that was 2019, 2020, they did extremely well. And it looks like they're doing extremely well now. And so that's about as much as I can say about that one. There's a lot of interesting things happening there. But other ones that are interesting that I think are memorable, Beyond Meat. I was involved in Beyond Meat at the Series A at my prior firm, so knew the team, knew the investors, and interestingly enough, that company for so many years, this is where the equity risk comes in. It was a gross margin negative business, and then at the juncture where it was like Series F, when we got back and re-engaged with them, I was kind of watching the space. They literally had crossed gross margin positive and started really taking off with the burger. And that's when we got really excited and all over it. And we came in at the round right before they went public. And so, we were able to help finance the growth of literally the factory that they built in Missouri to kind of scale the production process. So we were very helpful there. Some other ones that are more recent, Manscaped, as an example. We were involved in that one at the end of last year. Nothing really need to be said about the company. It's extremely successful, and Paul and team have done an awesome job. So I'll leave it at
They're
that.
deploying your capital everywhere. I see their ads everywhere.
They're doing extraordinarily well. And then other companies. Interestingly, recently we were involved in a company called Beauty Towner, which is now I believe one of the largest, if not the top. Clean skincare beauty brand, for women of a certain demographic, and they've done extraordinarily well even through the downturn. We were involved for 4 years. I was a board observer. They just sent me packing because our loan was due, and they paid us off, and they were very, very cash flowing extremely well, and everyone's very happy with when the time we came in. And the progress that they made, being extremely successful, and we love the team. We've got a great rapport with them. And then also an interesting one is IMVU, IMVU, which has been around since 2005. And that company, interestingly enough, is another example where the last equity round that they raised was 2010 in the middle of the downturn. And it was a down round, and long relationship with some of the VCs, and I had financed the company. This is a 3D avatar kind of social game business, and they actually trended pretty well for many years. Didn't burn a lot of cash. Kind of survived off of some large strategic deals, and just being very, very capital efficient. And many investors just didn't pay attention to them, but we did, and we ended up doing 3 financings with them between 2016 to the end of last year, where they literally paid us off at the beginning of this year, and they've been profitable effectively, for a number of years. And now, during COVID, the company grew by leaps and bounds, just because of the COVID effect. Everyone staying inside and using their phones. Company ended up with a very significant round that was led by NetEase. Late last year, we participated in a significant way for us on the equity side, and we're very excited about the company because in many ways they're a comp to Roblox, which has a $35 billion market cap. And so our company doesn't have quite as much of a market cap. I'm hoping that the market realizes that this is a very valuable business, and we're very excited about them and their prospects. And those are some of the interesting ones. Other one that I would point out that we were involved in very early is Epic Creations. Epic is one of the leaders in the kind of the ebook market, content market for kids in school, typically kind of grade kindergarten or preschool to grade 6, grade 7. They are used, as far as I know, in like half of schools now. They've done very well. We were involved all the way back at the Series Seed extension. It was actually literally our first deal in structural. We had a very small first fund, and it was literally our first deal. We ended up helping them get introduced to the eventual lead of the Series A when they had some challenges in the beginning, really communicating their story. And I actually spent a fair amount of time with them helping to hone that and also making good introductions. And now they're Series D and a very significant business and entity. So we get involved, we're helpful, and fundamentally we're just a well-aligned partner with many of these companies because unlike purely if you're on the equity side, you may be aiming for 10, 20, 50x. We're just very happy if the company is successful and the company returns our capital. We have a nice return. We're not aiming for home runs. We're aiming for singles, doubles, and triples. And if we end up with a home run, we're thrilled. But we're very well aligned with management as a result because whatever they want to do to grow the business, to get it to the right juncture, we're typically very happy with that.
Yeah, and you're not taking any equity, so you're not diluting them, so they don't feel like taking so much that it's turned into a job.
Yeah, I mean, we get warrants and then we get to
But
invest equity, but it's small. It's not exactly, they're not working
yeah,
for us at the end of the day.
yeah,
We want them to be really well aligned and have all options on the table for their paths of growth in the future. And so that's kind of our model mentality in terms of how we approach companies.
yeah. So you're 7 years into your company now. You mentioned that you're still a startup. Is it really a startup anymore at this point?
It's a great question. I will say that the first 4 years felt like we were still a startup. And then the last, I would say, kind of year, 18 months, it felt like we've really scaled the business. Our latest fund, we're going to do a press release soon. We just closed it. In total, the capital is over 300 million. So we're very, very excited about that. And we've deployed actually a good portion of it already and accelerating deployments and investments, finding great opportunities. But we now have 9 professionals on the team as of this week. We're continuing to grow the team, both on the infrastructure side as well as on the investment side. And so we think the future is bright. And in our business as a financial service fund, 9 people, is you're no longer like a startup, right? So if you were to sort of compare it to a typical startup, you're kind of like a Series C startup. You're not really a startup anymore, right? You're really kind of a business that's really starting to really scale.
Yeah.
So
How it's still a different beast, right? Like a high tech startup, usually we think of it as a product, typically, maybe SaaS products, right? Build a product, charge money for it, maybe freemium, some sort of user acquisition, raise money to build this product. How does starting, kind of like a capital firm, that's doing debt investments, how do you start something like that? Because the product is really capital.
yeah, the product is capital, but it's also the people at the end of the day, right? It's all about people having a great team, and it's exceptionally hard because in this business, you really your investors, your LPs, and we've gotten to some excellent LPs and really scaled with really strong institutional LPs. But in the beginning, it's exceptionally hard because most LPs that are institutional, they're really, they don't really need to take a lot of risk, right? And they're not in it, and they don't get the upside that you would get if you were investing in the Series A of a technology startup, right? You're not looking for 30x. They're really looking to make sure that they make good decisions with their constituents' capital. And so to convince people in the beginning, you really have to have the right sort of connections and track record and what have you. And that's not easy. And it wasn't easy for us. I know our fund one raise target was 100 million, and we were yeah, nowhere close to that. Our fund two target raise was 150. We ended up at just about 100, and then we ended up exceeding that with all these co-investments and other vehicles that we managed. And then our fund three raise targeted at 250, and we did exceed that. So we sort of really kind of came into our own, and proved out the model in many ways, like any startup would, right? So our first fund, we proved out that we could actually, be a good a steward of capital, generate returns, make investments, have a thesis, start building a team. And then fund two, we started to expand that team. It became a first institutional fund. And we ended up with, we literally just have paid back all of the loans, or all the loans have paid back to the fund as of this quarter, excuse me, the quarter just ended, Q1. And so we have, what's left is a fantastic portfolio of warrants and equity investments now. And so our LPs, should be very happy with the results so far. It's actually largely hit the targets that we've set, and we have significant upside. So we've done everything we've said we're going to do. And we expect, given this market, some very exciting outcomes in some of our portfolio companies. So we've really hit all the key points now in Fund Two to prove to our LPs that we can handle more capital and scale the business. And Fund Three is a direct result of that. And as a result of that, we think Fund Four will be just piggybacking off of Fund Three, doing exactly the same thing, and just doing more of it, and doing it in a bigger way, and seeing other opportunities arise as a result of that. So it's very difficult in the beginning. Literally, I would say your very first few checks, as any startup, when you're raising seed capital, to raise a $250,000 check from an LP in the beginning, is equivalent to, today, getting someone to write a $20 million check sometimes, because they really have to believe that you know what you're doing. And most folks are just not set up to take the risk, because as an LP versus as an investor in a startup, the risk reward is just very different.
Yeah.
Right. And so it's just a very different mentality that I totally get it, but now we've gotten past that point, and we've really proven out we know what we're doing.
Yeah. So I like to cover that too, right? How hard was it to raise money? Because you probably needed to raise even more money, because you have to use that money to write checks for other companies. So before you had a track record, what was that slog like? And were there any moments where it's like, oh you had any doubts?
Yeah, well, it's funny. A friend of mine who started his own fund once told me that, and he's actually starting a new platform now. He told me that you're going to be fundraising for 10 years straight. Whether you're in between funds or what have you, you're constantly fundraising. And that is the case. And as soon as you're done with one fund, you're raising the next fund, and you're scaling the business all along the way. And so the first fund was exceptionally challenging. We thought we had some LPs that were going to come in, and as always the case, they didn't come in when push came to shove. We ended up, really, needing a lot of friends and family help, particularly my partner's friends as well, in many ways. And we got some institutions that were, I think, really helpful along the way. But it was exceptionally challenging. The first fund took us literally about, I would say, about 18 to 20 months to raise.
Wow.
And it was a pretty small fund. And interestingly enough, it's like a bootstrap kind of garage startup in many ways, because the first days and the first meetings we took, I remember when we went to New York, we had to sleep on, we had to go get Airbnbs, and some of the Airbnbs that I stayed in, literally, one of the roommates of an apartment was not there, so you got to stay on the couch, or they didn't have soap in the shower. It literally was like that. And you take meetings the next day, and in the 90-degree heat in New York in the summer. And so there were some really, really challenging times where you really were bootstrapping because you had a limited budget. And neither my partner nor I kind of came from the perspective that many other managers may come from, where maybe they've had several billion-dollar exits and they can fly around in a private jet to go fundraise. We didn't have that. We literally bootstrapped it in many ways. And that kind of set us in many ways with the right discipline to kind of make capital go a longer way. Fund two, interestingly enough, we did still stay in Airbnbs, but nicer ones. And then we started staying in hotels, but typically kind of average hotels. And then Fund three, it was all hotels, but they were, they were the regular business hotels at discount rates. So
Yeah.
we set a nice discipline in terms of how we want to run the company and be, effective with and efficient with capital in all sorts of ways.
Yeah. Well, it's a good perspective. I think people go into, maybe they have a certain stereotype of someone in venture, and this is quite eye-opening that it can be as lean and scrappy as any other type of startup.
Yeah, yeah. In a different episode, we can talk about some of the crazy fundraising trips that my partner and I went on. But there were some dangerous places too that we felt we were in that probably shouldn't talk about right now, and I probably don't want to go back to again. So.
Yeah, yeah. Yeah, and did people ever hand you bags of cash or something?
Yeah, well, the thing is, all of those trips, they never ended up amounting to the capital. It ends up being, building those relationships that are more local in many cases and that take a lot of time. And then, as an example, in our current fund, we had one relationship. It's actually our first endowment that just came in. I won't name the name, but we're very happy and very proud of that. And it was because of a relationship that we had set up. It took many years to set up, and they said no to us probably 6 times over the course of 5 years. And they came in this final close, and we're ecstatic because our first meeting with them was, and this is the East Coast endowment. Our first meeting with them was we had to fly a red eye, and I don't sleep well on red eyes. I actually can't sleep on red eyes, and we had to drive 3 hours from the airport to get to the endowment. So couldn't sleep, drove 3 hours with my partner, my co-founder, and the meeting was 90 minutes. And about minute 75, and I do a lot of the talking because I've been in this business for many years, having helped to launch another firm. Um, minute 75, I literally found myself falling asleep, and I just couldn't stay up anymore. And so the meeting ended. We took another 3-hour drive back to the airport, got like 30 minutes of sleep, got back on another red eye going back the other way. And that was literally, how many of these meetings were. And so it's the same as any entrepreneur who's looking for their first set of checks, who necessarily haven't created and built and exited, $3 billion companies before, right? And so, and that was a story of our first fund. And fund two became a little bit easier. And then fund three, I wouldn't say it was easy at all because we went through COVID, but we had enough data points and excitement from the community from fund two that translated well into fund three. And we're very appreciative of all of that support. And many of our investors in fund one that were individuals came in all the way in fund two, came back all the way in fund three, and we are indebted to them. So it's been an incredible ride. The first 4 or 5 years were painful. Exactly. So
Yeah. Let's talk about kind of being Asian and being in this industry. Is that, were there any interesting stories or weird stories, or like, because, maybe it's not typical, or at
yeah,
least kind of my impression.
yeah, that's a great question, and it is less typical. Um, I start to see more and more of the LPs and the decision makers within those firms, or relatively close to the decision makers. I see more Asian faces now, which is great. As a manager, I still think it's relatively few, um, and there aren't any in my asset class other than myself and some of the other folks on my team, as far as I know. But it is few and far between. A friend of mine who I've actually become friends with, a woman that runs another fund on the distress side. She and I have actually chatted a few times because she grew up in New York, and I'm happy to introduce her. She may be a good story for you as well.
Yeah.
And she's literally on her first fund, and she's raising it, an Asian woman. And we've kind of shared notes and commiserated around some of the challenges. But for us, I didn't notice anything in particular, only because my partner is Caucasian, I'm Asian, and I think that at the end of the day, we were just scrappy kind of first-time fund managers at the end of the day. He's a long-time entrepreneur, has had a ton of success, and also had some misses as well. But I think that combination worked out really well. Um, but at Fund Two, I think that message started to resonate, in terms of the track record of what we've done. And Fund Three, I didn't see any. I didn't feel like there was a headwind at all, to be honest. In many of the meetings, it just didn't become an issue. And so, I think as an Asian American manager, at least I didn't notice, any sort of predisposition in any other way. So I think that as we get more and more Asian managers out there, I think there's some good associations that have formed and have kind of created communities. I think it's going to be more commonplace.
Yeah, it's definitely, it seems more commonplace today and more than ever. Uh, I guess, having gone through the first.com too, like what made you decide to start this kind of startup as opposed to more traditional tech startup, and
Yeah, it's a great question. So, um, I guess the way I'd answer it is I've always been on the financial service side. I love tech. I like to be a user of it, not a programmer. I like to pretend in some ways that I know more than I do. I don't really try to pretend. I like to understand and research, but at there's only a certain level that kind of a non core tech person engineer can get to, right? So I can't build the product.
yeah.
But from a finance perspective, you understand what the product is. It's capital and yourself and the service that you're providing to who you're actually providing that capital to. Because it's not just capital. Anyone can raise capital from any sources these days. There's more to it than that. And that's what kind of helped my old firm, which I kind of helped to instill that discipline into my prior firm to be successful. But for me, it was in many ways, in turning 40, I felt like the clock was sort of ticking, and that there's a big opportunity out there. And just having young kids, that if I waited 3, 4, 5 years, and really waited to be kind of truly financially, independent, or what have you, I think that timing would have been missed. Because now, knowing what I know in terms of how challenging the journey is, it made it all the more worth it in many ways. If you asked me 3 or 4 years ago, I probably wouldn't know what the answer was. But today, it made it all the more worth it. But you need a certain amount of energy. And so, for me, thinking about starting a business like this, platform like this, getting if I started at 45, I think it would have been challenging. Starting at 40 was sort of like that point where you still had the energy and the ability to really run around and get going and do whatever it took to make it work. Kind of like burn the shit behind you and just go forward and not look back. And what I see a lot of times is, when people get kind of a bit later in their career, they start to have one foot in, one foot out. Sort of like, well, I don't want to lose what I have to try to get something more special. But that's really hard for that to work. In cases I've seen, it's really what I tell and counsel people is you really have to burn your ship and just go and make it work and throw everything at it. And that's easier when you're younger, right? And fundamentally, and in our business, you need a track record, right? And so that track record isn't built typically until you're 35 plus. So between 35 and 40 is, in many ways, if you've got a long enough track record for what you're doing, or if you're in a tech person's perspective, starting another company, having built a lot of products as a CTO, what have you, it takes a number of years to kind of get that track record and to get that kind of respect from the community that you know what you're doing.
Right.
And
And raw experience, like, yeah, I
yeah,
mean,
life
from
experience as well, right?
20 years
Exactly.
ago, didn't know shit.
Yeah, 20 years ago, I was a VC associate guy looking at all these things and seeing the environment completely change. And to now, 20 years later, having been involved in a couple hundred companies and having good pattern recognition of what's a good opportunity for us in this model versus what's a better equity bet versus what's a better debt investment, what's in between, and really kind of also having that relationship network of people that you can count on as well. And that's really helpful.
Yeah, thanks for that. Um, I know that we kind of taking back, like, I was looking at your journey, and how do you're a VC associate at the firm we were both at, and then you leave under some circumstances, but then so you became a principal at Osprey.
Well, I became an associate at Osprey, and
Oh, so
yeah,
okay,
and
and
then
then the
became a
title.
principal.
Okay, got
Then
it.
became a
Associate
principal.
first, got it.
Yeah.
I was like, hey, that's kind of a jump.
So I'll go into some depth into this story because it's definitely interesting. But and this kind of goes to you kind of further understand kind of how I think and kind of the entrepreneur in me. So this venture firm that I joined, first time fund, the managing partner is a great guy. We're still friends. His name is David Stasny, great guy. Um, he had an ad out there, and I had been looking to find a way out west for quite a while, even before my time at V Capital. I felt like the Chicago scene for me, and largely because it felt at the time, I don't know how it is today, just very kind of staid, right? Very old fashioned in terms of business practice. And there weren't a lot of Asian American business leaders that I could look at and say, I want to be this person. I saw this person get successful, and here's why and how I want to be this person as a role model. I didn't see many, and it's interesting because when I was in college, and my dad worked in a restaurant. I was manager. I didn't own a restaurant. He once introduced me to a partner at E&Y because I was a CPA when I first got out of school, and I got a chance to ask the guy, hey, what makes you tick, and what made you successful, and what he was a tax partner, and what made him successful was basically he moved out to LA from Chicago because again, he didn't see a lot of business role models for him to model himself off of success. So as soon as he started getting success in Chicago, he knew that he felt like his career was sort of that it was capped, but it would be uncapped in LA because of the wider variety of clients that he could help to get for that firm. And so that kind of stuck with me a bit. And as a result, when I was before V Capital, I was at a really great firm called BNP Paribas, it's an investment bank or a French merchant bank. Fantastic business. Love the business, love some of the team members there. I still keep in touch with some of them. But I still remember many times working till 3 a.m. I was on the Bloomberg machine looking for jobs out west, and I sometimes apply and they wouldn't pay anything because they would find lots of candidates that were in LA or in Bay Area. And so when I went to V Capital, I said maybe this is an interesting shot. I'm going to jump on this roller coaster wave of the internet boom, right? And obviously V Capital, didn't necessarily have that success that we were all hoping for. But I found this ad, and it was, hey, I'm looking for a couple associates, and I basically took the onus and said, listen, V Capital is not really trending in the right direction. Let me go and interview. And I literally came out on Father's Day and met my boss at Bucks, a very famous place at Bucks on a Sunday. A lot of transactions happened there, and he was so impressed with me because he said, you came out on Father's Day. You must really want this job because I have a stack of resumes this high. And I was like, listen, I'll do it, whatever you want. I want this job. And so what he offered me was an internship. He didn't offer me a full associate role. He offered me an internship at a let's just say less than minimum wage rate.
Oh man.
And I don't tell everyone the story because it's definitely a colorful story. And so then what happened is I decided not to accept it. And there's a lot of things that happened at V Capital, and then I ended up accepting the job. Ended up, dragging my now wife, fiance out west with me, on a shoestring budget to go for it, to really go for it, right?
Yeah.
At 27, you're gonna go for it. You're gonna kick yourself if you don't go for it and try. I could have stayed in Chicago, become a VP, a director, maybe a managing director at a bank or what have you. Fine, great, what have you, but I would have kicked myself because I didn't go for it.
Yeah.
And so I did. And, interestingly enough, I got here in July of 2000. The very first deal we did, company was supposed to be acquired by Cisco or someone, a memory business. We had 2 hours to get into the deal, and we're driving up, like literally the first week I'm here, driving up in my boss's car to the city for some meetings, and literally had to make a decision in 30 minutes. I mean, that was how crazy the environment was. And of course, that company didn't get bought for $1 billion. We didn't lose our money. We didn't get bought for $1 billion because the environment completely changed, whether because of 9/11 or because the environment completely changed 3 months later, right? The downturn had started. And the environment completely shifted to you literally were doing deals in 30 minutes because that's all the time you had to you couldn't get a deal done for 9 months. No one was investing.
Mm.
And so yeah, it was definitely a roller coaster. And having seen the Nasdaq go up and down, what I saw was the lenders that were smart and knew what they were doing. They often didn't lose any money because they were senior secured. They were out first, and if you didn't overstep your bounds, you actually did a consistently good, generated consistently good returns, relatively consistently good relative to venture, even as the Nasdaq was dropping like a rock. And so that got me thinking about, maybe it's better to go back to the debt side because that's where I got my credit training at Paribas, and kind of blend that knowledge set I had acquired on the equity side with debt that I already knew. And so I got the call in 2005 from a recruiter who was one of our LPs about a startup that had just raised, a large sum of capital, and they were in the basement of our building. And interestingly enough, I said to him, I was like, listen, I'm interviewing. I've got another offer from a large family office that their office is in 100 University, and that the tall building, they own that building, I believe, and they want me to help run their private equity portfolio. And he said to me, you know what? That's a job for a 50-year-old. You're 30 years old. You're 32 years old. What are you doing? You don't want that job. And then I said, okay, fine. I'll meet these guys. And one thing led to another. And I ended up, not taking the offer and going to this startup called Triple Point Capital, which has become successful. I was a big part of that early success. And then I found some inefficiencies in that model, which, in many ways led to us not doing deals like Box and others, Coupang as another example, and a lot of other successes that we missed for, a lot of reasons because the business model was different. And that led me to think about starting Structural because I felt like I can marry my equity experience and having helped a lot of companies with my debt background and looking at alternative, pockets of growth in areas that really need the capital. And we still look at the same kinds of deals, but we just have a very wide lens of what we can do. And I found, that this can be a very successful, very, very large niche for what we do. And so that's kind of leading us to where we are today. If you're 27, you just got to go for it.
Go for it. Yeah.
Yeah. And what's really funny is this. My brothers, I'm the youngest of three. When I got my first bonus at Paribas, it was like, well, actually, it was supposed to be coming. And I got the offer from V Capital. So this is 1999. And the V Capital guys said, you have 2 days to take the offer because we have 4 of the people waiting for the job. And I talked to my bosses there. I was like, guys, this internet thing is so exciting. I think I just got to do it. And they were like, listen, I totally get it. Here's a raise if you want. Your bonus is $30,000. If you want to stay, this is what you're going to get. You have a path here. But I totally get if you want to do this because you're at that age. I totally get it. So I left with their blessing. My brothers were like, are you insane? You're leaving a $30,000
It's
bonus. Yeah,
$30,000. Yeah.
exactly. And I'm 27. This is like 1990, yeah, 1999. And a lot of people make a lot more money even back then. But for me, it was like a lot of money. It was my first sizable bonus. And I was like, my brothers were like, you're a moron. What are you doing? And I was like, I got to go for it. And my brothers, they take different paths, right? They didn't take the risk path. And so I took the risk path, and V Capital became what it was. I took another risk path, and that became where I am today. It sort of led me to in different ways to where we are now.
Yeah.
And that's where you are. You're the sum of your experiences, right? At the end of the day. And I found that I'm actually an entrepreneur. So I really resonate, and when I hear their stories and I can tell them my story, it really resonates in terms of understanding where people come from. And it's really helpful. And particularly Asian entrepreneurs now, when I talk to them and they understand where I've come from, everyone appreciates that. And there's a lot of support for that.
Yeah, there's a lot more, and actually that's partly why I'm doing this is to create that support and create that have those stories and learn from each other, and also like you mentioned, role models. I didn't see a lot of role models, and then a lot of the stories, a lot of the more popular podcasts. There's just not role models that look like me, and that's why I reached out when
Yeah,
and got
I'm
reconnected. Wanted
I'm
to
glad you
hear,
did.
yeah, I
Yeah.
wanted to hear that story, and also share that story. I guess to wrap up, we have one question I like to ask is like, so like if it weren't structural capital, what would it be if you took a different path?
When I decided to leave my prior firm, it grown to a size and the structure changed and the opportunity set um, for growth just wasn't there. Um, I there were other funds that were I was talking to that were interesting. There were other banks and other jobs, and what I felt was, again, going back to the same theme of, what, you've got several shots in life. You've got to take it. You got to take the bull by those horns and just kind of go for it. I felt like that was the best path. And there were other more safer paths at the time that I think my family would have been happy with if had taken. But fundamentally, I'm still an entrepreneur, right? And I thought about starting a technology company with other people, but I felt like, where are my skills and where's my network that's been built? Where can it be most useful? And frankly, what's my passion, right? And what I figured out, in my prior job, as well as when I was on the venture side, was I really like working with entrepreneurs. And so for me, it was really about being helpful, but not trying to be overbearing in many ways. Sort of like, I'd love to be part of that success story,
Mm-hmm.
no matter how small part of it. But it's great to have been a part of it and to provide that support. Versus, in many cases, you got control investors that want to, be the success story. They want to basically say, hey, I own 20% of this company or that. I'm very happy, being part of that success story and playing whatever role it may be. Maybe it's just a very simple financing role. Maybe I actually really helped them raise capital, or maybe I got on the board and helped them in a bunch of different ways. And it's that service mentality that, I think I've kind of learned over the years that it's really a lot of fun, and to kind of pull back from your ego, what have you. You just want to be part of that success, right? Just seeing that success of a company go from X to Y to Z. uh, it's exciting.
Yeah.
And that's kind of what I felt like for me. How can I best find a path, to do that, right? And so at Structural now, thinking about like where we're going to go as we grow, there are lots of avenues for us to continue growing, whether it's different types of investment products, in different parts of the capital structure, different stages of companies, different types of companies, different geographies. But it's all the same kind of perspective. It's, we want to be known as people that kind of add value to companies and are, not detractors, but we take risk, and we get a relevant return. And we at the same time, want to be viewed as good partners and value-added partners. But again, in our business, we also protect ourselves. And so I just love that. It's sort of like, in many ways, you're sort of hedged in many ways, right? And so that's what I've found a lot of passion just to do.
Yeah. Very similar mindset to me. I think when I was younger, as well, a lot of ego, wanted to be like a design CEO, design founder. Kind of wanted that glory. But as you got older, I developed this service mentality. I mean, at the end of the day, Impeccable is an agency, a service agency. We help design and build stuff, and I'm happy being part of that journey. I'm happy playing my part. As a early design team for Firebase, which then had a great exit to Google, or it's a Zingbox, which got acquired to Palo Alto Networks. We were their design team. So like being part of that story of, hey, we kind of provided those services and support. Yours being capital, mine being
Yeah.
design, product, UX, whatever.
And people
Um,
remember that, right? And they
yeah,
appreciate it because the really smart entrepreneurs, when they see that, let's say, I'll give you an example. one of the companies, gaming company that I was involved in, I think the entrepreneurs even said, because of using your capital at that time, we saved ourselves, each of the two co-founders, like $20 million each.
Hmm.
And because they didn't take the dilution, right? And so, that perspective and when they think about starting their next company, they would probably say, yeah, let's see if we can use that capital and from that person again. And so there's so many of these companies and entrepreneurs and CFOs and CEOs that have come back to us, and that's how Fund One and Fund Two largely got off the ground. But so many repeat customers that that I worked with, and one of them, I'll give you an example before we finish, is was a VP of finance at Beyond Meat back at the Series A, Series B. He remembered me. He really liked the interaction. He sought me out in the beginning of Fund Two, and he became the CFO of Beauty Counter, which is hugely successful now. He left Beauty Counter, became the CFO of Sunfed Ranch, which is opposite of Beyond Meat. It's a company that we hope to see to become the largest in the U.S. at least organic and kind of all natural grass fed beef business, and they're growing by leaps and bounds. And so he called again and said, "Really love working with you." And so in this company, we're taking a little bit more of an active role, almost like a sponsor. But having those calls over and over again, it's so satisfying to know that people did appreciate what you did.
Yeah,
You
yeah.
know,
It's very, very similar. I have very similar stories in the company I run, right? Like you
yeah,
do a good job at a big enterprise, provide these services, they go to another company, they're like, oh, Impeccable did a good job, Peck did a good job, love working with him, drag us along, stays there a couple of years, goes to another company, brings us along with that too. And it's funny that it's our businesses are so different, but yet they're so the same. And it's like you do a good job, you have a great reputation, great relationships. Yeah.
yeah. You realize when you get older, right? Whatever business you're in, it's all about relationships in many ways, right?
Yeah.
I mean, if you're trying to build a new product, that's great if you're that kind of person. But in many cases, that's like a young person's game, right? And
Yeah.
as you get older, it's really about your reputation and relationships that you
Yeah.
build, and making sure that people respect that and appreciate that, and that's a very satisfying thing.
Yeah. That's all business is the reputation. Do you say what, can you do what you say you do? And can you do that over and over again?
Yeah,
Yeah.
and it seems to be hard enough already.
Yeah. That itself is so hard. Awesome. Well, Kai, thank you so much. I had a lot of fun, and it was pleasantly surprising to hear that your business has, even though it's again very different. Again, it's not that much different, and I think we can all relate to some of your early hustle days, and yeah, that's really comforting, I guess.
I think the lesson at the end of the day is, you really took, for at least for me, is if you really want it, you really have to go for it. And in many cases, you have to just be willing to, leave other things behind and just aim for it, right?
Yeah,
So
burn your ship.
and just, focus your attention on it, because things move so fast. It's really hard uh, to really kind of focus on too many different things if you want to be successful at any one of them.